Hi, I'm Keith McCullough. Welcome back. Today I want to talk about a very trivial thing in markets, which is what's working. So again, what is working? As opposed to what you want to see happen in the market, what is actually happening in the market? We often talk about trading the market that you have as opposed to the one that you want. So I don't particularly care if I'm long or short certain markets. I just want to be right. So let's start with what's working beyond 3 weeks. As we get into this part of the year, these are things that could actually trend. So what I'm going to go through quickly is countries that are working and sectors specifically within countries that are working, because that's a really good place to start. And again, we're talking about stocks, so that's where we're going to start with the first slide. The first slide tells you what is specifically working. The top 3 stock markets in the world for the year to date. Greece. Who would have thought? Who would have thought? It's Greece. Now, did all your brokers and high net super worth advisors tell you to buy Greece? No. That's why Greece is probably working. So again, think about it. Just think about it. Over and over again, you have this pervasive fear that the world was ending. Evidently did not. Greece is number 1. Portugal, which you'll recall last year, was number 3. And if you go down the line, you're going to see a very simple theme continue to manifest that we've been all over here at Hedgeye, which is being bullish on European stocks. We call it being Eurobulls. So after Greece and Portugal, Denmark's up over 6%. Austria's up over 6%. There are ETFs for all these things, so hopefully you're long of that. Now let's look at what is not working. Now, what's not working, bottom 3 performing equity markets for the year to date. China is sucking the tailpipe of a performance life. That is awful, down 5.3%. Who wants to be Chinese when you can be Greece? You know, I mean, this is a huge performance divergence. And again, we call them growth divergences in the world. Brazil continues to act awful. Olympics, World Cup, whatever. I mean, this is terrible. And Japan, just because everyone and their brother owned it and it was overbought, is down. So again, it's just called selling what had worked. So again, think about what are the trends that are emerging here. Again, like Europe on the long side, more of the same. The MSCI Emerging Latin American Index, for example, for the year to date is down 4.6%. That is in stark contrast, for example, versus the Euro Stoxx 600, which reflects the prior slide of what's working. The Euro Stoxx 600 is up about 2.5% for the year to date. So again, growth divergences, big global macro theme at Hedgeye. Now, let's get into the U.S. The U.S. has more sectors to consider here in terms of what is and what is not working. So if you can look on this slide, consumer discretionary is terrible, just terrible for the year to date. Never mind the S&P 500 being down 0.5% for the year to date. Last week, consumer discretionary stocks got killed. They were down 1.5%. They're down 2.6% for the year to date. Whereas healthcare, up last week on the week, up 2.85% for the year to date. So we call this a performance divergence at the sector level. So again, sector picking, in as much as stock picking and country picking, we went through the countries, really matters here. Why could consumption growth slow? We've talked about that. So again, as inflation accelerates, another big theme here at Hedgeye, we would expect consumer stocks to underperform. We have a lot of great short ideas across the board, from Cheesecake Factory to Red Robin, Gourmet, whatever they're making. I mean, these stocks do not act well for a reason. Now, final slide. This is a really interesting slide. Got mean reversion? Yeah. Now, this looks a little busy, but it's not. It's called variance. Now, variance, just explained simply, is do we have any variability in sector level returns? Now, what you'll see here is the historical mean, and I'm looking at the dotted line, X.com bubble years, of about 1.43%. So again, we're going back towards that. What does that mean? Well, what it doesn't mean is that a monkey could do it. So again, when you don't have any variance in the sector performance, all the sectors go up or they all go down. Now, sector variance, again, can make a monkey right on the long side or on the short side. Much more difficult when sector variance rises, which we're starting to see. Again, consumer down, healthcare up. Much tougher. Again, people talk about being a good stock picker. We macro people, we muckers of the world who have to grind it out, we talk about picking sectors, we talk about picking countries, because it really matters. You can't just buy everything all at the same time. So those are the things I want to go through here in terms of what's working. If you have any questions, please ping me. @Keith McCullough is my Twitter handle.